What's up, you guys? Welcome back to the channel. If you guys are new, my name is Evan and I post videos 3 times a week on Monday, Wednesday, and Friday. I post videos about hot stocks, options, and dividends. So if that interests you guys, make sure you subscribe and hit the notification bell so you never miss any uploads. But in today's video, we're going over one of the better options trading strategies for small accounts, and this is debit spreads. So let's not waste any more time and let's get into it. So as you can see here, I have TNA pulled up, which is a relatively steady stock and it tends to have an upwards trend. So it's a good stock to explain how debit spreads work. So a debit spread basically has the same principles as a normal call or put, except you're not risking as much money as a normal call or put. So when you buy a debit spread, it's a lot like a credit spread if you guys know what a credit spread is, but it's slightly different in the fact that you want the price to go the same direction as what you're buying. So I'll explain that a little bit better here. So if you're buying a call debit spread, you want the price to go up, much like if you bought just a normal call. But the only difference is that it's basically the opposite of a credit spread, where a credit spread, you sell the more expensive premium here. So we would sell this one and you'd buy this one and you would make that difference in credit. Well, with a debit spread, it's the opposite. So it's flipped. So instead of selling the more expensive premium, you're buying that more expensive premium and you're selling the cheaper one. But I'll give you an example down here. So say we wanted to open a debit spread here on TNA and we thought the price was going to keep going up. We would open a call debit spread. So for this example, we'll use this $35 strike and this $34.50 strike. So we're going to sell this $35 strike at $190, and then we're going to buy this $34.50 strike at $220. So you pay the difference between these two, between the two premium prices. So in this case, it would be 30 cents difference between these, but that's times 100. So you'd pay $30 to open this debit spread. Now the profit comes when the price stays above this 35 strike at expiration. Because you're paying to open this spread, it's different from a credit spread, where with a credit spread you're getting credited that money, so that money goes into your account. With a debit spread, you are paying to open this spread. But the profit is the difference between the strike prices minus what you paid to open it. So we paid here $30 to open this spread, because remember, $220 minus $1.90. So that's 30 cents times 100. So we would pay $30 to open this spread. And then the difference between the two strikes is 50 cents times 100. So the difference there is $50. So that would mean our profit here is $20 as long as at expiration, the share price stays above $35. So if you're ever trying to figure out what your profit is, you just take the difference between the strike prices minus what you paid to open it. And remember that you are always buying the more expensive premium and you're selling the cheaper one. And one misconception with debit spreads is that people think that they're just like a credit spread, where with a credit spread you make money from time decay. Because a credit spread, as the spread gets closer, you make the difference between the original spread and the new spread, but that's your loss on a debit spread. So if this 220 and this, what was 190, now it's 189, but we'll just pretend it's still that 30 cent difference. As time moves on, generally this spread will get closer together, because as theta sets in, normally that will bring the spread closer. And as the spread gets closer, you lose that difference between what you originally paid and what the new spread is currently worth. So to give you a quick example here, if we open this spread down here, this debit spread, so we paid for this $294 and we sold this $257, the difference between these two is $37. Well, now the price just changed, so now the difference between these two is $35. So if we open this spread here for $35, and then as time moved on, maybe this spread was only worth $30. Because it's now worth $30, we would lose $5 on this spread if we were to close out early. But as long as the share price stays above this spread, we would profit the full amount. So for this one, it would be the $50 difference between the strikes minus our $35 difference here. So it would be $15, and that would be our max profit at expiration as long as the share price stays above this strike of $34. If the price dropped below our entire debit spread, so it dropped below $33.50 at expiration, we would lose what we paid to open it. So in this case now it's worth $38. The difference between these, we would lose $38. So that's your risk to open this debit spread. And your max profit is the difference between the strikes minus what you paid to open it. If this seems at all complicated to you guys, don't hesitate to leave a comment and I'll go more into detail in the comments if you need it. But let's go over a quick example with puts. So if we were buying a put debit spread. So again, with a put debit spread, you want the price to go down because it's just like if you were buying a normal put. So the price right now is $35.95. So for example, say we open this debit spread here. We buy this $37.50 and we sell the cheaper one. So the same thing applies for a put debit spread in the sense that we want the price to go the same as the normal put. So we want the price to stay below this $37 strike. But you can see we're opening it for a cost of $36 and the difference again is a $50 difference between the strikes. So our max profit is going to be $50 minus $36, which is $14. And we would earn this full $14 as long as the price stays below $37. If it goes above $37.50, say it ended at $38 at expiration, we would lose the $36 that we paid to open this spread. So debit spreads aren't really all that complicated as long as you understand that you're buying the more expensive premium and selling the cheaper premium. So I'll just kind of wrap everything up here just so you guys know the main things to watch out for and what to keep an eye on when you open a debit spread. So the first thing, obviously, you want the stock to move in the same direction as what type of debit spread you're buying. So a call debit spread, you want the price to go up, just like if you were buying a call. A put debit spread, you want the price to go down, just like if you were buying a put. The only difference is that you're not paying nearly as much as if you were buying just a normal put or call. And because of this, your profit margin is a lot less and you have a limited profit, but you're not risking nearly as much. So remember this one, we have a $36 cost, but if we bought just a normal put, like say we bought this $229, that's going to cost us $229 versus only $36. So the way a debit spread makes money, if you were to close out early, keep in mind this is only if you're closing out early, is if the spread gets wider. So if you closed out early and the spread is wider than when you opened it, you would profit the difference between the current spread and what you opened it for, which was the smaller spread. If you're not closing out early, you don't have to worry about that as long as the price stays above or below your debit spread depending on what you chose. And the way that a debit spread gets farther apart is if the price continues moving in the direction that you are hoping for. So for a put debit spread, as long as the price continues dropping, this spread of $36 is going to increase. And therefore, if we closed out early, we could secure some profits. So as long as your spread gets closer to the money or deeper in the money, you would make a profit if you closed out early. But keep in mind, you wouldn't make the entire full profit. You would only get a portion of it because you only get the full profit if you wait until expiration. Oh, and before I wrap this up, I wanted to know from you guys whether you like it better when I use the lighter colored layout on Robinhood or the darker version. Do you like the light theme or the dark theme? Because I've made a couple videos using both. So let me know down in the comments because I'd be curious what you guys think of both themes and which one you guys like watching better. Also, if you guys don't know how credit spreads work, I'll leave a card up in the top right that you can click on, and that will bring you to my video describing how credit spreads work and why, in my opinion, they're slightly better choice than debit spreads. But you'll have to watch that video through to see why I think that credit spreads are slightly better. So I think this about wraps it up. If you guys have any questions, leave them down in the comments. I know this can be a little tricky to learn at first and a little complicated to understand. But as you start doing it, you kind of build up these skills and it becomes almost second nature and you don't really have to think about what you're doing. Especially with Robinhood, they kind of label everything for you, so you can't mess up as long as you're reading what it is. So when I buy this premium and sell this premium here, it tells me that it's a put debit spread. If I switched them around, it would say a credit spread. So just let me know down in the comments if you guys have any questions. As well as if you have any video suggestions, something that you don't understand, I'd be more than happy to make a video on it, so let me know. If you guys enjoyed the video, make sure you hit the like button. It really does help out the channel and promotes my videos to more people. So I would really appreciate it if you guys hit the like button. Also, if you guys are new, make sure you subscribe and hit the notification bell. And with that said, thank you guys so much for watching, and I'll see you back here in the next one. Bye.